Hello everyone. So in this short topic we are going to discuss about asset allocation and how to make asset allocation based on a ratio called as market cap to GDP, and how do you make asset allocation based on yield curves. So before starting with these two things, let us understand what does asset allocation means. So asset allocation means allocating your money across different assets like equity, gold, long-term debt, as well as short-term debt and any other assets that comes into your mind. So asset allocation is simply how much money do you allocate to equity, gold, long-term debt and short-term debt while you are creating your portfolios. Now there are certain investment policy statements and there are certain restrictions that you face as a portfolio manager. But apart from that, if you're handling your own capital, you need to make a call between how much goes to equity, how much goes to gold, long-term debt, short-term debt, etc. Now there are different ways to go about it. One is passive allocation. So irrespective of market conditions and external variables, you decide an allocation and you stick on to it. So let's say your allocation was equity is 60% and your long-term debt and short-term debt is 40%. So debt is 40%. Then irrespective of performance of equity and debt, you keep the asset allocation constant to 60/40. Now what happens if equity market falls? The debt allocations become higher, the equity allocations become low. So then you remove money from debt and you bring it to equity. If debt market falls and equity market rises, then equity allocations become higher than 60 and debt allocations become lower than 40. Then you remove money from equity and you bring it back to debt. So you keep on reshuffling between these assets based on how different they are from their stated allocation. So this is passive allocation. Irrespective of market condition, you will keep on putting 60% of your money in equity and 40% in debt, and you will reallocate them based on their performance after a certain time interval. The next is active allocation. So in active allocation, you switch between equity as well as other assets based on some technical parameters. So these technical parameters can be market cap to GDP or yield curves. So active allocation means based on some external parameter or an external ratio like market cap to GDP, after analyzing it, you decide how much goes to equity and how much goes to debt. So you don't make a static allocation like 60/40. You keep on reshuffling based on your estimate of how these assets are going to perform. If you think equity is going to give you very good returns, you allocate higher towards equity. If you think equity is not very safe right now, you need to go into gold, you go into gold. So you are doing it actively. You are not doing it passively. Now, how to decide? So there are two simple ways to do it. One is market cap to GDP ratio and second is yield curve. So what is market cap to GDP ratio? Let us first understand it, then look at its example. So it's a ratio. So any ratio has two parameters, numerator and denominator. In numerator, we have market capitalization of stocks, market cap of listed stocks, and in denominator we have gross domestic product. We also can have gross national product, or we can have gross national income. But irrespective of what you use, the logic remains the same. So this ratio is composed of market cap in numerator, and in denominator we have gross domestic product, GNP, GNI, etc. Now there are two things that can happen. Either this ratio can increase or this ratio can decrease. If this ratio is increasing, what is happening? Your numerator is going up, and your denominator is going down. So if this ratio is increasing, it means your markets are going up, but your gross domestic product, your economy is not doing very well. So even though markets are going up, your economy is not so well. So market cap is rising when it should not. When it decreases, it means markets are going down, that is numerator is going down and denominator is rising. So it means markets are crashing but your economy is doing well. So it means that. Now what we generally do, if this ratio is too high, if the market cap to GDP ratio is too high, we move into safe assets. So we reduce our equity allocation and we go into safe assets. If this ratio is too low, we reduce our allocation to safe assets and we increase our allocation to equity. So it has a very simple interpretation. If this ratio is too high, you move away from your equity and go into safe assets like gold and short-term debt. If this ratio is too low, you start investing into equity. It is as simple as that. Now, the values of too high and too low can be a bit of debate here. So what is too high and what is too low? So if you see US data, US market cap to GDP ratio, it has a range from around 149% to as low as, let's say, around 33%, right? So when this ratio is too high, so it is somewhere above 149 etc., you try to remove the allocation to markets, means to equity, and go into safe assets. If it is too low, it is somewhere around somewhere below, let's say 80, so 80 or 85, below 80 or 85, you increase your allocations to equity. So simple rules: if it is below 90 or 85, you allocate more towards equity. If it is near about 150 or it is crossing 150, you reduce your allocations to equity and you go into safe assets. Next way to decide asset allocation is yield curve. So there are three things: normal yield curve, then there is flat yield curve, and there is inverted yield curve. Now what is yield curve? So if you can see from this picture, oh, it's not there now. So let's go to Google and find out a yield curve picture. So this is your yield curve. It's a graph between how much yield are you getting, how much interest are you getting, how much returns are you getting vis-a-vis maturity of assets, maturity of debt. So example, a 6-month maturity instrument will have a yield that is lower than a 30-year maturity instrument. So a 30-year maturity instrument will have yield that is higher than a 6-month maturity instrument. This is very logical because in 30 years you are blocking your money for 30 years, so you don't have liquidity for 30 years. So the person who is borrowing from you has to compensate you for that loss of less liquidity or the lower liquidity that you have. So he pays you a higher yield. So as the maturity increases, the yield increases. This is the normal yield curve. Now in certain cases, the yield curve becomes flat and then it inverts. So your interest rates or your returns on short-term debt becomes more than returns on long-term debt. So inverted yield curve means your returns on short-term debt are more than your returns on long-term debt. Now if this is the case, then you move away from equity and go into safe assets. So decision is, if the yield curve is upward sloping, you still continue investing in equity. But moment the yield curve starts inverting, you move away from equity and go into safe assets. And again, when the inverted yield curve again starts has an increasing slope or a positive slope, that is it becomes normal again. The moment it gets normal, you start investing into equity. So based on this yield curve, again you can make asset allocation decision. So just to summarize, asset allocation means how much money are you allocating to different assets like equity and debt or any other asset for that matter. You can base this decision on two factors, either market cap to GDP ratio, or you can do it on the basis of yield curve. There are many other ways to do it, but this is something that is very simple to follow. So market cap to GDP ratio is also called as Buffett indicator because Buffett uses it a lot. So it's a ratio. So what we look for it, if the ratio is higher or near 150%, you go into safe assets. If it is less than 85 or 90%, then you go into equity. Yield curve, you have three types: normal, flat and inverted. When the yield curve is normal, you invest in equity. When the yield curve starts inverting, you move away from equity and go into safe assets.